A brand's equity is like the goodwill a person builds over years of reliable behavior. It is the set of assets and liabilities linked to a brand's name that add or subtract value to a product or service. Brand equity, general, is the differential effect that brand knowledge has on consumer response to the marketing of a product. Customer-based brand equity, Keller, is the mental associations and the strength of those associations held by consumers. Brand awareness is how easily the brand comes to mind. For example, Coca-Cola's name is instantly recalled when you think of soft drinks. Perceived quality is the consumer's judgment of a product's overall excellence. For example, Apple is seen as high quality. Brand associations are personal, functional, or emotional links. For example, adventure for the North Face. Brand loyalty is purchase intent and advocacy. For example, Tesla owners repeatedly buying new models. Akker's brand equity model 1991 splits equity into 4 pillars: brand loyalty, perceived quality, brand associations, and brand awareness. Think of a 4-legged stool. If any leg is weak, the stool wobbles. Keller's customer-based brand equity, also called CBBE model, is a pyramid. First, brand identity, awareness, then brand meaning, performance, and imagery, then brand responses, judgments, and feelings, then brand relationships, resonance. Imagine building a house. You first lay the foundation, awareness, then walls, meaning, then windows or doors, responses, and finally live in it, relationships. BAV Brand Asset Valuator by Young and Rubicam uses differentiation, relevance, esteem, and knowledge. Picture a sports car. It must be different, unique design, relevant, fits driver needs, esteemed, high status, and known, brand name recognized. These models help managers break down an intangible asset into manageable pieces, making it easier to measure, manage, and grow the brand. Valuing a brand converts its intangible worth into a dollar figure, similar to how a house is appraised based on location, size, and condition. 3 common methods are: 1. Royalty relief method, also called income approach. Assume the firm paid a licensing fee, royalty, to use the brand. The brand's value is the present value of the royalty stream it saves. V equals the sum from T equals 1 to N of royalty rate at time T times projected sales at time T divided by 1 plus discount rate raised to the T power, where R sub T is the royalty rate. For example, 5%, S sub T is projected sales for year T, R is the discount rate, and N is the forecast horizon. Exercise: a coffee chain expects sales of 200 million, 210 million, 220 million in the next 3 years. Royalty rate equals 4%, discount rate equals 10%. V equals 0.04 times 200 divided by 1.1, plus 0.04 times 210 divided by 1.1 squared, plus 0.04 times 220 divided by 1.1 cubed, equals $7.27 million approximately. 2. Price premium method, market-based. Compare the brand-priced product to an identical unbranded or private label version. The extra price is attributed to brand equity. V equals the sum from T equals 1 to N of the difference between brand price and neutral price times quantity sold at time T divided by 1 plus discount rate raised to the T power, where P sub B is brand price, P sub N is neutral price, and Q sub T is quantity sold. Exercise: a premium sneaker sells for $120, a comparable generic sells for $90. Expected units equal 500,000 per year for 5 years, discount rate equals 8%. Annual premium profit equals parentheses 120 minus 90 right parenthesis times 500,000 equals $15 million. Present value equals $15 million times open bracket 1 minus open parenthesis 1.08 raised to the negative 5 close parenthesis divided by 0.08 close bracket, approximately $61.0 million. 3. Discounted cash flow, DCF, brand-specific cash flows. Isolate cash flows directly attributable to the brand. For example, incremental margins, marketing spend saved. V equals the sum from T equals 1 to N of brand cash flow at time T, divided by 1 plus discount rate raised to the T power. Exercise: suppose brand-generated incremental cash flow equals $10 million annually, growing at 3% per year, discount rate equals 9%, horizon equals 10 years. V equals cash flow 1 times open bracket 1 minus open parenthesis 1.03 raised to the 10 times open parenthesis 1.09 raised to the negative 10 close parenthesis divided by discount rate minus growth rate close bracket, where cash flow 1 is 10, growth G equals 0.03, R equals 0.09, N equals 10. The value is approximately $88.5 million. Key takeaways. Choose a method that matches data availability and purpose. For example, royalty relief for licensing-intensive brands, price premium for consumer goods, DCF for long-term strategic planning. Brand asset tracking metrics index construction and statistical validation. Monitoring brand health over time is like checking a car's dashboard. You need a set of gauges that together tell you whether the vehicle brand is running smoothly. Core metrics. Brand awareness % of target respondents who recognize the brand unaided or recall it. When prompted, aided example 68% unaided awareness for Nike among US teens. Perceived quality rating usually 1 to 5 of product quality relative to competitors example Apple scores 4.6 versus average 3.8. Brand loyalty repeat purchase rate or net promoter score example Starbucks NPS about 70 indicating strong loyalty. Brand associations measured via semantic differential scales, example innovative old-fashioned. Index construction. Step 1. Standardize each metric to a common scale z-score z, I equals xi minus mu I divided by sigma I. Step 2. Weight according to strategic importance example awareness, 30% quality, 30% loyalty, 30% associations, 10%. Step 3. Aggregate brand index equals sum from I equals 1 to k of wi times zi. A statistical validation. Reliability Cronbach's alpha checks whether the combined items consistently measure the same construct alpha greater than 0.7 is acceptable. Construct validity using confirmatory factor analysis CFA verifies that observed variables load on the intended latent factors awareness quality and so on. Predictive validity regress future sales growth on the brand index. If beta is significant, the index predicts performance. Practical example. A mid-size apparel brand creates a quarterly brand health dashboard. Awareness unaided 62 weight 3/10, perceived quality 78 weight 3/10, loyalty repeat 55 weight 3/10, brand associations innovation 68 weight 1/10. Standardizing each score applying weights and summing yields a brand equity index 68 over 6 quarters. The index climbs from 62 to 71, confirming that recent product innovations are paying off. Why it matters. A validated index provides a single comparable figure for senior leadership, allowing quick decisions, for example, increase media spend if awareness dips. Brand architecture is the family tree of a company's brands. Similar to how a large corporation may have a parent brand, the family name, and individual children products. The way you arrange that tree determines how brand equity is shared or divided. Strategic architecture types. 1. Monolithic branded house. All products share one master brand. Example, Google, Google Search, Google Maps, Google Drive. Equity is concentrated. A strong parent lifts every child. 2. Endorsed. Sub-brands have their own identity but are backed by the parent brand's endorsement. Example, Courtyard by Marriott. Courtyard is the sub-brand, Marriott is the endorsement. The parent lends credibility while the sub-brand can target niche markets. 3. Sub-branding. Hybrid. Sub-brand receives a distinct name and visual identity but is linked to the parent through a clear relationship. Example, Apple iPhone, Apple iPad. The Apple prefix transfers equity, yet each product builds its own. 4. Freestanding. House of brands. Independent brands under a corporate umbrella, each with its own equity. Example, Procter & Gamble, Tide, Pampers, Gillette. Each brand stands on its own. Corporate equity is minimal. Impact on equity allocations. Concentration versus diffusion. Monolithic concentrates equity, high leverage, low risk of cannibalization, but can suffer if the master brand is tarnished. Cross-selling opportunities. Endorsed and sub-branding facilitate cross-selling because the parent endorsement reduces purchase risk. Resource efficiency. Monolithic and endorsed architectures recycle marketing assets, advertising, packaging across many products, saving costs. Analogy: think of a restaurant chain. Monolithic: all outlets are Pizza Planet, a single name, single menu style. Endorsed: Pizza Planet Fancy Pizza. The main brand assures quality, but the specific concept tailors to a premium audience. House of brands: different restaurants, Pizza Planet, Burger Bay, Salad Studio under one corporate owner. Each must build its own reputation. Decision framework. Situation: strong trusted master brand and desire for cost efficiencies. Recommended architecture: monolithic or endorsed. Situation: need to target distinct market segments with divergent positioning. Recommended architecture: sub-branding or house of brands. Situation: high risk of brand-specific controversy. Recommended architecture: house of brands to isolate risk. Situation: introducing a radical innovation that could confuse existing brand perception. Recommended architecture: sub-branding, new name with parent endorsement. Key point: the architecture should align with the firm's strategic goals, market heterogeneity, and risk tolerance. Once chosen, equity metrics can be allocated accordingly. For example, 60% of brand budget to the master brand, 40% to sub-brands. Building equity is like training an athlete. You must invest in the right activities, training, nutrition, coaching, and measure the performance gains. 4PS and their equity levers. 1. Product, innovation and quality. New features signal relevance and improve perceived quality. Example: Dyson invests heavily in research and development. Each new vacuum model raises the innovation association. ROI formula. ROI equals delta profit product minus investment divided by investment. Dyson spends $150 million on a new motor. Expected profit uplift equals $45 million per year for 5 years. Discount rate equals 10%. Present value of profit uplift equals $45 million times, open bracket 1 minus open bracket 1 plus 0.1, raised to minus 5 close bracket divided by 0.1 close bracket, approximately $173 million. ROI equals open parenthesis 173 minus 150 close parenthesis, divided by 150 equals 15.3%. 2. Price premium and value perception. A deliberate price premium reinforces luxury positioning. Example: Louis Vuitton maintains high prices to preserve exclusivity. Price premium ROI. Compare incremental margin from premium to extra cost of brand building. Luxury watch brand raises price by 10% from $5,000 to $5,500. Expected sales volume drop equals 5%. Incremental margin equals $800 per unit. Initial volume equals 20,000 units. New profit equals 0.95 times 20,000 times open parenthesis $800 plus $500 close parenthesis equals $12.42 million versus old profit equals 20,000 times $800 equals $16 million. Net loss equals $3.58 million. The brand must assess whether long-term equity gains, higher NPS, future pricing power outweigh short-term loss. 3. Place distribution. Selective distribution signals prestige. Example: Tesla sells through owned showrooms, controlling the buying experience. Distribution ROI. Measure incremental sales from premium channels versus cost of channel development. A cosmetics brand opens 30 boutique stores at $250,000 each, $7.5 million total. Each store contributes $500,000 annual profit. Payback period equals $7.5 million divided by $500,000 equals 15 months. 4. Promotion, communication, and sponsorship. Advertising builds awareness and associations. Media ROI. ROI equals open parenthesis incremental sales times margin minus media cost close parenthesis divided by media cost. A snack brand runs a television campaign costing $2 million, generating an incremental 2 million units sold, each with 50 cents contribution margin. Incremental profit equals 2 million times 50 cents equals $1 million. ROI equals open parenthesis 1 minus 2 close parenthesis divided by 2 equals negative 50% negative. However, brand equity gains, higher awareness, may have future value not captured in the immediate ROI, prompting a long-term equity ROI measurement. Integrating ROI into equity building. Short-term financial ROI tells whether a specific activity pays back quickly. Long-term equity ROI captures the value of enhanced brand equity, for example, future price premiums. This can be estimated using the brand equity valuation methods from Topic 2 applied to the post-campaign equity uplift. Practical template for MBA projects. Table columns: activity cost, expected equity effect, short-term ROI, long-term equity value valuation. Row 1, new product launch, $30 million cost, plus 5 points awareness, plus 3 points quality effect. 12% short-term ROI, $45 million long-term equity value, royalty relief. Row 2, social media influencer program, $5 million cost, plus 7 points relevance, plus 4 points loyalty effect. 8% short-term ROI, $8 million long-term equity value, price premium. Understanding both sides enables managers to justify equity building, spend even when immediate cash flow benefits look modest. Bottom line, allocate budget where the combined financial ROI and projected equity value give the highest overall return on brand investment. Think of brand equity management like piloting an aircraft. You need a cockpit dashboard, metrics, regular maintenance checks, audits, and an autopilot that adjusts course when turbulence, market changes appears. Core components: monitoring system, ongoing collection of brand health data, awareness, quality, loyalty, associations. Usually automated through brand tracking surveys, social listening, and sales performance dashboards. Auditing process, periodic deep dive, quarterly or annually, to verify that the brand is delivering on its promise. Includes brand asset audits, visual, verbal, experiential, and financial audits, valuation versus book value. Adaptive control feedback loop. Use insights to adjust strategy, similar to a balanced scorecard for brands. Financial perspective. KPI brand generated margin percent, target 18% or higher, initiative premium pricing and cost to serve reduction. Customer perspective. KPI net promoter score, target 70 or higher, initiative loyalty program and service training. Internal process perspective. KPI time to market for new product, target 6 months or less, initiative agile development and cross-functional pods. Learning and growth perspective. KPI employee brand advocacy index, target 80% or higher, initiative internal brand ambassadorship program. Implementation step 1, define KPIs. Align each KPI with the brand's strategic pillars, for example, innovation leading to research and development spend efficiency. Implementation step 2, collect data. Use a mix of primary surveys and secondary sources such as sales and web analytics. Automate via business intelligence tools like Tableau and Power BI. Implementation step 3, score and weight. Convert raw numbers into a uniform 0 to 100 scale. Apply strategic weights, for example, financial 30%, customer 40%. Implementation step 4, dashboard review. Management reviews monthly. Significant deviations trigger an exception report. Implementation step 5, corrective action. Root cause analysis 5 whys leads to action plans, for example, increase advertising spend or redesign packaging. Brand audit checklist. Identity is the logo used consistently across touch points. Positioning, does the value proposition match customer expectations? Experience, are service standards met in each channel? Financial, does the brand valuation align with projected cash flows? Legal, are trademarks protected in all key markets? Adaptive control example. A sportswear brand notices a 4-point dip in perceived quality from 82 to 78 in its second quarter dashboard. The exception report flags it. The brand team runs a quick focus group, discovers a recent material change lowered comfort. Action, fast-track a new material batch, communicate the improvement through an email campaign, and monitor the metric for recovery. Within 1 month, quality rebounds to 81. Why a framework matters. It converts the fuzzy concept of brand health into a repeatable, data-driven process, allowing chief executive officers to allocate resources with confidence and to respond swiftly to market shifts. Takeaway, adopt the balanced scorecard style view, run regular audits, and embed a feedback loop. This turns brand equity from a static asset into a dynamic capability. Brand equity dilution and protection, legal repositioning and crisis management tactics. Brand dilution occurs when a brand's unique meaning weakens, much like a loud radio, losing its distinct song when too many stations broadcast the same track. 1. Legal protection. Trademark registration secures exclusive right to brand symbols, logo, name, tagline. Example: Starbucks holds trademarks for its mermaid logo worldwide. Design patents guard distinctive product shapes. For example, Coca-Cola bottle prevents copycats that could erode distinctiveness. Domain and social media monitoring use services mark monitor brand shield to detect cyber squatting or fake accounts that could confuse consumers. Enforcement issue cease and desist letters, file infringement lawsuits. If needed, the cost of litigation is often less than the long-term equity loss. 2. Repositioning strategies. Refresh without losing core, update visual identity while keeping the core promise. Example: McDonald's modernized its golden arches, but kept the fast, friendly food message. Segment-specific repositioning creates sub-brands or endorsed brands to target new markets without cannibalizing the parent. Example: Toyota launched Lexus to enter the luxury segment, preserving Toyota's value for money image. Brand extension controls limit extensions to categories where the brand has relevance over extension. For example, a luxury fashion house launching low-cost home appliances can dilute prestige. Quantitative dilution test. Use a brand dilution index BDI based on 3 variables: awareness drift, a D quality drift, QD association drift as D. BDI equals 1 minus open parenthesis, a sub T times Q sub T times as sub T close parenthesis divided by open parenthesis, a sub 0 times Q sub 0 times as sub 0 close parenthesis, where subscript 0 equals baseline year T equals current year. If BDI equals 0.12, equity has diluted by 12%, management can set a threshold BDI less than or equal to 0.05 and trigger a repositioning plan when exceeded. 3. Crisis management tactics. Pre-planned response matrix define crisis levels: low, medium, high, and corresponding actions. Statement: press conference recall. Rapid social listening deploy tools: Brandwatch, Talkwalker to detect spikes in negative sentiment. Transparent communication admit fault, outline corrective steps, and offer restitution. Example: Johnson & Johnson's Tylenol recall, 1982 Swift recall, and new tamper evident packaging restored trust. Post-crisis equity recovery analysis measure post-crisis changes in NPS awareness and perceived quality. Use the recovery rate RR equals open parenthesis metric post minus metric crisis close parenthesis divided by open parenthesis metric pre minus metric crisis close parenthesis. A RR greater than 0.8 indicates strong recovery. Case-based quantitative example. A premium chocolate brand suffers a contamination scandal pre-crisis. NPS equals 75, crisis NPS equals 45, 6 months later NPS equals 65, RR equals open parenthesis 65 minus 45 close parenthesis divided by open parenthesis 75 minus 45 close parenthesis equals 20/30 equals 0.667. Recovery is 66.7%, suggesting further actions. For example, third-party certifications are needed to regain full trust. A protective playbook summary. 1. Legal guardrail: register, monitor, enforce. 2. Strategic guardrail: keep extensions aligned, refresh visual identity, carefully use endorsed sub-brands. 3. Crisis guardrail: have a response plan, monitor sentiment, communicate transparently, and measure recovery quantitatively. Key insight for MBA students. Treat brand equity like a living asset. It needs legal patents, strategic health checks, and an emergency kit. Quantify the impact of threats and recoveries to make the case for protective investments to the CFO. Explanation: exam focused problem sets - typical MBA brand equity questions with solutions. Problem 1 - brand specific price premium. Data: a tablet brand sells 1,200,000 units at $350 each. A comparable non-branded tablet sells at $280. Variable cost per unit equals $150 for both. Calculate the annual price premium profit attributable to the brand. Price premium per unit equals 350 minus 280 equals $70. Incremental revenue equals $70 times 1,200,000 equals $84 million. Incremental contribution margin since variable cost is identical equals $70 times 1,200,000 equals $84 million. Brand-specific price premium profit equals $84 million. Answer $84 million annually. Problem 2 - forecasting brand equity growth parentheses awareness index parenthesis. Data: current unaided awareness equals 45%. Past 3 years growth rates 8%, 6%, 5% year over year. Management expects the growth rate to continue decreasing by 0.5% each year. Forecast awareness for year 5. Growth rates for year 4 and year 5. 5% minus 0.5% equals 4.5%. 4.5% minus 0.5% equals 4%. Year 4 awareness equals 45% times 1 plus 0.045 equals 47.025%. Year 5 awareness equals 47.025% times 1 plus 0.04 equals 48.906%, approximately 48.9%. Answer: approximately 48.9% unaided awareness in year 5. Problem 3 - royalty relief valuation. Data: expected sales for the next 4 years. $120 million, $130 million, $140 million, $150 million. Industry royalty rate equals 5%. Discount rate equals 12%. Year 1, 5% times 120 million equals 6 million. Present value equals 6 million divided by 1.12 equals 5.36 million. Year 2, 5% times 130 million equals 6.5 million. Present value equals 6.5 million divided by 1.12 squared equals 5.19 million. Year 3, 5% times 140 million equals 7 million. Present value equals 7 million divided by 1.12 cubed equals 5.0 million. Year 4, 5% times 150 million equals 7.5 million. Present value equals 7.5 million divided by 1.12 to the 4th power equals 4.78 million. Total value equals 5.36 plus 5.19 plus 5.00 plus 4.78 equals $20.33 million. Answer: brand value approximately $20.3 million. Problem 4 - ROI of a new product launch. Data: research and development cost equals $25 million one time. Marketing spend equals $10 million per year for 3 years. Expected incremental contribution margin equals $12 million per year for 5 years. Discount rate equals 9%. Cash inflows years 1 through 5, $12 million each year. Cash outflows, year 0, $25 million research and development. Years 1 through 3, $10 million marketing each. Net present value inflows equals $12 million times open bracket 1 minus open bracket 1 plus 0.09, raised to the -5 close bracket divided by 0.09 close bracket, equals $12 million times 3.889, equals $46.67 million. Net present value outflows equals $25 million plus $10 million times open bracket 1 minus open bracket 1 plus 0.09, raised to the -3 close bracket divided by 0.09 close bracket equals $25 million plus $10 million times 2.531 equals $25 million plus $25.31 million equals $50.31 million. Net present value equals $46.67 million minus $50.31 million equals -$3.64 million negative. Return on investment equals net present value divided by total investment equals -$3.64 million divided by $50.31 million equals -7.2%. Interpretation: the project does not meet the 9% hurdle. A redesign or cost reduction is needed. Problem 5 - brand dilution index calculation. Data: baseline year 0 awareness 70, quality 80, association score 75. Current year 3 awareness 60, quality 70, association 68. Brand dilution index equals 1 minus open bracket, a 3 times Q 3 times association 3 close bracket, divided by open bracket, a 0 times Q 0 times association 0 close bracket. Numerator equals 60 times 70 times 68 equals 285,600. Denominator equals 70 times 80 times 75 equals 420,000. Ratio equals 285,600 divided by 420,000 equals 0.68. Brand dilution index equals 1 minus 0.68 equals 0.32. Answer: brand equity has diluted by 32%.